touch upon some of the major themes that are going across APAC and China and across the globe. And then we'll take a bit of a look at Hong Kong and what's on the horizon for investors here. Let's start at for 10. Valuations, volume, and cap rates. Gentlemen, where are we in the current real estate cycle? Stanley?
Maybe Frank, you can start first because you see more deals than me.
Okay. Yeah, well, I guess this year the stats actually, I saw David from RCA here earlier on. Oh, there he is over there. And so I'm just quoting your figures. Please don't correct me, though. So basically, I think for Asia Pac, it's about $100 billion US dollars in income-producing sales across Asia Pac. 10% down, sorry, 9% down on last year. But what's interesting about that is that 100 billion amounts to the 4 top cities in the US. So LA, San Francisco, New York, and New York Metro. Yeah? So what that shows is that there are very, very few deals in Asia Pacific, unlike super low deals. So like cities like Beijing and Shanghai combined will do less than London. So what it shows is that we're very lowly leveraged out here. The market is dominated by big families and big business locals. So 95% of all real estate in Asia is owned by, local Asia Pac entities who don't sell because their point of view is that, so for instance, this building here, Swaz, they sell the resi, they keep all the commercial, and they get, great income. And that's the same for Sun and Kai, the Chinese guys, Singaporean guys, and Capital Land, and so on and so forth. So you just do not see any of these guys trading their commercial real estate. So that, in a nutshell, is that we're very, very strong, very lowly leveraged. I mean, so some of the big guys here, they have gearing sub 10%, and they're $50 billion US dollar companies, biggest in the world, some of them. So there's just very, very little debt.
Yeah, I echo Frank's comments. The cap rates in the key cities, Frank mentioned Shanghai, Beijing, Singapore, for example. The cap rates are within the range of 3 to 4.something%. They have not moved that much in the last few years. And there is plenty of liquidity in the market, although there is a credit tightening in China, which we'll cover later. And that's why for us, TCA, we have development strategies to be able to pick up the development margin and value it. But for core properties, it's a very tight market.
Yes, and so if you go more on the cap rates, so you're right. So a grade A office building in, say, Shanghai, Beijing, Singapore, Hong Kong, where else have we got? Tokyo, the cap rates all range between 3 to 3.5%. And in some cases, like in China, borrowing is 5%. So you do the maths. So it's quite difficult for private equity to get into the market because basically the opportunistic add value is tough to realize at the moment. So we're seeing a lot more core sovereign wealth, REIT, pension money in the markets picking up core assets at that 3 to 3.5% mark.
Any questions off the bat for our distinguished guests? Yep. Run down.
That was a quick question.
Hello? Oh yeah, I've been thinking about this since last night, so that's why. With all the stability and low leverage and that you described with these closely held assets where they're put in the Hong Kong REITs or a few business trusts, why do they trade at these massive discounts with very little trading volume? You would think, with all the good on-the-ground metrics, they would be robust and at least trading at NAV. What's the disconnect when you compare it to maybe like a Singapore REIT market or a US REIT market where, I think with the exception of Link REIT in Hong Kong, everything is well below NAV. What's the disconnect between on the ground and obviously the reason the KKRs and the Cerberus haven't come and done breakups is because they are so closely held. But how do you reconcile the on-the-ground fundamentals and low cap rates and the massive discounts to NAV and low trading volume in the public markets?
I think the main reason is because the large listed companies in Hong Kong are tightly held by the families, and they have a very low leverage. And a lot of the land, for example, is not marked to, say, fair value because they have a massive land bank. Yeah, I think that's one of the main reasons.
But I guess the question, I'm sorry.
Yeah.
If the building trades at a 2 cap in Hong Kong, but based on the NAV calculation in the public markets, it's a 7 cap. That's a huge delta. Is that because it is so closely held, or is there something that the public owners of those securities know about that the Guailos don't know about?
I think probably because a lot of these companies have a mixed-use portfolio. I think the big cash driver is residential, right? They build and sell. And then they also hold the prime commercial. And then you also have a land bank.
So the private equity guys, I mean, so they've been in Asia, say, for 15, 20 years. So they came in, say, say 97 to 2005. They came in quite heavily, and they did very, very well. So they were buying buildings at 5, 6, 7 caps all over Asia. But as the market compressed, basically they are not able now to go into those deals because obviously the returns for investors are way, way more. So they're now basically all those big private equity guys are looking at buying platforms and are buying businesses, joint ventures, and actually sometimes in many cases joint venturing with developers who need another source of capital and so on and so forth. So that's their model. That's been their model for the last couple of years, I guess. So the core stuff now, as I said before, very, very few deals are being done. I mean, what Asia does, the top 4 cities in the States do. So it's just a very illiquid illiquid in a good sense. There are plenty of buyers still. I mean, the other stat I've got, David, is that there is $38 billion of dry powder for Asia Pac. Just dry. So you double that up with debt. I mean, you're tapping his knee. Okay, yeah, and so it's a bit too close, this, isn't it? So I can see virtually what everybody's doing. But so you've got close to 80 billion of equity. 80 billion combined to buy real estate, and that's just basically 1 year of income-producing deals in Asia Pac. So it's a very, very small market, and I must say I can't see it changing, even if there are black swans in the future. I mean, the debt of these guys is just maybe apart from China. China's a different beast, but all the other SEA, Hong Kong, Tokyo, Seoul, very lowly leveraged. The banks are incredibly cautious. They don't lend. I mean, so if you wanted to buy this building here, a commercial bank wouldn't lend you more than 40%.
So does that create an opportunity for a CMBS market here?
Yes, it does. Yeah, especially in the China markets. Yeah, absolutely. Yeah.
Fantastic. Any more questions? No. Thank you, Steve. Just staying in China, Stanley, Chinaman, what is your outlook for China real estate moving forward?
I would say in terms of general macro environment is tough because of credit tightening and a lot of the non-traditional banking channels have been shut down, and also the trade war. But it depends which side you're on. If you're on the buy side, I think it's a great window of opportunity because there's less competition from the local mainland developers. And that's why you're seeing an influx of foreign capital into China despite the trade war. So for us, we focus on Shanghai, Greater Shanghai, and Beijing, where there is still quite fierce competition for good quality stock. Yeah.
Fierce competition. Do you echo?
Yeah, I mean, we're in 16 cities in China, maybe 20, I can't keep count, but But I mean, the other day we were doing a very large deal, and in a tier one city, sort of northish, and we had over double. I'm talking sizable. I won't say what it was because people will guess, but it was big, and big for us anyway. And we had we had double-digit bids. So when something comes on, you get a lot of attention from the offshore guys. So anything from sovereign wealths, from balance sheet guys, developers, so on and so forth. But I mean, we're banning on this trade war thing. I was reading something in the FT the other day, and it was saying that US manufacturers have been in a downturn since August. I think 9 months, actually, consecutive downturn. And I think the point is, even though the China PMI is slightly below 50, it's either slightly below or it's above. And whether you believe that or not, I don't know. But the point is, it's it's quite resilient. And the Caxin, which came out the other day, was above, that's small and medium enterprises, that actually was above the 50% level. So I mean, I think that there are always two stories you read in the papers. 1 minute China's hemorrhaging, and next minute it's being resilient. But I mean, it's the long game about China. I mean, they're not going to, in our opinion, I think Stanley's online, they're not going to buckle. They're going to come to the table. They're going to be pretty fair. But I mean, this first one is a truce. It's not a deal. It's a truce. I think it's just really to get Trump over the line in the next election. Basically, he can go out and just say, I've done a deal. But I mean, I think there's a much bigger deal to be done, which is not necessarily trade. It's more about AI. It's more about 5G, all these sort of things, which the West is absolutely terrified about. But maybe I'm a bit blinkered, but I've been here 30 years. Off to Shenzhen in a minute. But the point is that I think maybe Huawei won't get into some of the more core Western markets, but they will be in probably 30-40% of the world, so they're going to have to live with that.
I mean, what does... sorry.
You probably read about the Singles Day sales festival started by Alibaba. On the 11th of November, it clocked $36 billion in 1 day, which was a 25% increase, right, from last year, despite the trade war.
Yeah. I mean, what does this sort of trade war, Cold War 2.0, mean for Hong Kong investors, for Hong Kong capital on the ground here?
To go to China?
Yes, I mean, are we going to see more direction towards China? Are people going to bulk away from China, go to the rest of APAC? Does it have any bearing on a Hong Kong real estate investor?
Hong Kong investors the developers obviously are very well positioned in China. I mean, they've got heaps of land bank and so on and so forth. But the family office and the individuals probably will do nominal stuff, maybe a little bit of an apartment here, maybe a little bit of a retail here, but nothing huge. I mean, the family offices tend to go to traditional safe havens, So London, I think London is an absolute steal, regardless of Mr. Corbyn and Johnson and whatever. And what's the other guy? Farage, that's it. Buying a prime London building at a 4.5 cap. I mean, you don't get that in Asia. I mean, here it's even with the problems here, nobody's going to sell below 3. They just don't have to. So, but London at 4.5, but London volumes are down 40% this year. I mean, so it's amazing. So I think London's done 14 billion this year, US. Hong Kong did that in the first 6 months, and then it completely dried up. But I think the London markets are, all the stories about tenants leaving, jumping off to Frankfurt. I mean, Frankfurt's the size of Chung Kwan O and Tuen Mun. Yeah, it's 700,000 people. It's a small place.
Michelin star restaurants as well.
Yeah, that's right. There
Only
you go.
4.
So I can't see, too many tenants. It's all about talent, isn't it? And London has a lot of good talent. So I can't believe that we're not seeing more. Well, maybe we are. Maybe we will see once there's a bit more clarity on the election. We will see more people, more Singaporeans and honkies going to London.
You still can't
I mean, Brexit, I mean, London's looking good, but how about the rest of the UK? Is there any investors here who, well, you are investors, obviously, but deal in the UK? I mean, how are you finding the second-tier cities?
The province is way stronger. We've done a couple apartment deals that are in places like Birmingham, Manchester, and the low fours. As a matter of fact, stronger than London because greater demand, greater population growth, more job growth.
Yeah.
Manchester, Birmingham, Bristol.
Wales?
Trading Wales too. Trading stronger than London.
Oh, fantastic, fantastic. But I mean, it is interesting how, let's talk about no-deal Brexit and the economy's going to fall off the cliff, but people are more scared of a Jeremy Corbyn government than are of a no-deal hard Brexit. Just a bit of a comment there. Sticking with Hong Kong, it's been in the news quite a lot recently for obvious reasons. I mean, what do you guys see as the outlook for Hong Kong when it comes to real estate? I mean, is this another SARS opportunity here?
I had a chat with Frank over coffee. I think he's more bearish than me. I'm more bullish about Hong Kong in the medium and long term. I mean, maybe let you start first, Frank.
Well, as a broker, we don't really like flat markets. We want up or down. I've got 2 presentations on my laptop, whichever way you look at it. So anyway, but I live here. I'm engaged. I'm invested. I think that in the stats. So from '97 to 2003, the economic financial crisis in Asia and SARS, it went down 67% real estate, resi, really. But this time around, in the last 5 months, we've seen probably the primary market down about 15%, developers churning and burning their stuff. And then the second-hand market only down about 5%. But I do think that will go down because I can't see any end to this current situation because China won't force it because otherwise they'll be held to account. And the government are pretty weak, and unless they come up with something pretty stellar, it's going to continue, I think, for many, many more months. And so the market will drift on low volumes, and low volumes always means that basically most people don't have to sell. A great stat I've got is in the last census, I think 3 years ago in Hong Kong, so there's about 1.2 million properties held in the private sector and about 1 million in the public. In the private sector, 60%, well, I'd say 60, let's call it 55%. 55% of homeowners are mortgage-free. It's the highest in the world. So basically, people just don't have to sell. And if anything, what they do is the parents, they become the bank of mum and dad for their kids. So they will take out a small bit of debt, and they put that down as the deposit for buying a new home. So I don't see it's just going to be massive low volumes, apart from the primary stock, where the developers are just going to have to discount. But the second-hand market will remain very, very strong. So I don't see there's going to... if I could have put something on the line, I probably would go, if you have to sell in 3 months, you're going to have to take a 20% hit. But you'd have to do that anywhere in the world, wouldn't you now? London, you put your property in the market, you want the cash in 3 months, you've got to take a discount. So I would say it's the same as something like here. Arguably, I think the whole market probably will go down maybe 20-25% over the next couple of years.
You have a slightly different opinion, slightly different view?
Yeah, obviously, Hong Kong is in the news every day, and it doesn't look good. But I think the fundamentals are still intact. I don't think there will be a crash here compared to '97. For example, the interest rate is super low here, and most of the owners are very lowly leveraged. And also, there's a scarcity of supply in Hong Kong. And also, the bigger picture is the connectivity with the Greater Bay Area. And there's still ample liquidity here. I mean, a lot of people said about money shifting to Singapore, for example. But the liquidity here is so much bigger than Singapore. I think if you compare the stock market, it's 10 times that of Singapore, based on my recollection. Yeah.
Okay. I mean, does anyone have any opinions in the audience about how Hong Kong is looking in the short and the midterm future? No opinions. That's your problem, not mine.
But I mean, the other interesting thing, so only 7% of Hong Kong is actually built upon. So 76% is country parks, basically. So, I mean, arguably a lot of people are saying that, why don't we build on some of the country parks, 1% of the country parks? So that would, you could build, hundreds of thousands. What about the shipping container terminal in Kwai Chung? I mean, that is, we're now number 6 or 7 in the world. Do we need it? You could build a town the size of Chung Kwan O there. You could build a town for 400,000 people there. There are plenty of opportunities in Hong Kong, but just government has, and I've got to get off here because I get a bit angry, but there are certain interests that keep the land pricing policy high.
Okay, so we're coming into the last 5 minutes. Does anyone have any burning questions or topics they'd like to raise? Oh.
Okay. I told you, I've been thinking about this all last night with these guys. Do you see an analogy between London and Europe and Hong Kong and the rest of China as, Europe has been trying to displace London as the financial capital for decades, but obviously all the great things about London and British common law, you just can't. You see the same analogy as with Hong Kong, as sort of the financial capital of China, where people are trying to displace it, but just the facts on the ground, given the history, common law, people want to live here. Does that give it the resilience that we're seeing now?
Well, I mean, look, come on. Shanghai will surpass Wall Street, New York in 10 years' time. I mean, I think it's a fact. GDP has already been, China's already overtaken. It's the world's it's number 2, but it's it's only GDP per capita that's holding China back at 10,000, whereas the US is what, 50? Here's about 45. Singapore's 55. No, I think ultimately, if you look at China. China's 1.3 billion people. The US is what, 350? And the US has got what, 3 or 4 financial capitals? Big ones and small ones. So, I mean, Shanghai ultimately will be the financial capital of Asia within 5 years probably, and 10 years globally. Hong Kong will be the hopefully with Shenzhen, if it plays its cards right, the capital of southern China, and it will be the capital markets for southern China. I think that's how you look at it. You need 3 or 4 financial centers. Beijing ultimately could be a financial center. I mean, it's 24 million people. It's a very wealthy city. So you're going to have plenty of financial capitals in China. And I'd say that Hong Kong still, China wants it to be, its window to the world. But if things don't perk up a bit, then I think they will say, well, look, Shenzhen's got its own stock market. It's got, much of the IT and the AI, and it's a really vibrant, it was what was it? It was 30 years ago, it was almost like a fishing village. I mean, it was, 300,000 people. Now it's like 9 million people. So, I mean, and Shenzhen's GDP overtook Hong Kong a couple of years ago. So, I mean, Hong Kong's GDP in 97 contributed 27% to China. Now it's 2.7%. So it's a big, obviously the China one's grown massively, but Shenzhen has, the focus has been making Shenzhen a real, financial and IT hub.
But isn't the big difference between Shenzhen and Hong Kong? In fact, Hong Kong has got contract law, English common law. Shenzhen doesn't have that. So you can talk about GDP, but Hong Kong will always have that. As long as it keeps its basic law, it'll always have that trump card over Shenzhen, right?
Yes, I think China is big enough to accommodate at least 4 financial centers. Obviously, Shanghai, and then you have on the mainland you have Shenzhen, and maybe not many people aware that Beijing is also a very significant financial center, mainly servicing SOEs. But going back to Hong Kong, is the most international city in Greater China, And also, this is where a lot of FDI flows into China. I think from our perspective, we can't see like any other route other than Hong Kong if you are to bring in FDI into China. Because simply you have the benefit of less restrictions or very little restrictions of capital flows, low tax environment, the English law, the contracts, and so forth. Yeah.
Sunny, that will change, though.
I don't see that. Well, for the maybe near term,
Next 30 years, maybe?
maybe 20 years. Because we work with a lot of local partners, and now it's like China is opening up for FDI, and Hong Kong is still the place. Yeah.
So just one interesting about the US trade war, which maybe just to finish off on, was that I was up in Shanghai a couple of weeks ago, and they had a big import conference up there. And basically, there was a 20% increase of American delegates. And the reason is this whole trade war is basically governmental. But still, I don't know how many states there are in the US, but it's all about those particular states doing business in China. And they still came out there in force. They still have to do day-to-day stuff. You know, the soybean guys, whatever it is, those guys still have to do their deals. They don't really care about what's going on with Trump and Xi Jinping on the bigger story. They still have to try and look after their own interests. So there's still plenty of US interest. It's just, but all you see in the press is the high-level stuff. But down below, people still, you know, the US, EU, you know, they still want to do business with China because, you know, at the end of the day, that's how they're going to keep their factories and so on and so forth going.
Yeah. I think $80 billion of deals were signed, right? Yeah. I don't know. But I can see Hong Kong being displaced in terms of ports, exhibition, and so forth. But financial services, I think, is still very strong.
Look, we have run out of time. A huge thank you to both our panelists for taking time to speak with us today.